Investing legend Warren Buffett has built his empire on shrewd stock picking and strategic investments. But now, in a surprising twist, he's found himself in a war with index funds. Yes, you heard that right. Welcome back to our channel, where we delve into the latest in the investing world. Today, we're exploring an unexpected battle brewing in the finance sector: Warren Buffett versus index funds. Warren Buffett, often referred to as the Oracle of Omaha, is one of the most successful investors in history. With a career spanning over 7 decades, he has turned Berkshire Hathaway into a financial powerhouse through his strategic stock picking and long-term investment philosophy. But what exactly are index funds? Simply put, index funds are collections of stocks grouped together based on common characteristics. They track the performance of a specific market index, like the S&P 500, which includes 500 of the largest companies listed on U.S. stock exchanges. Unlike actively managed funds, which rely on fund managers to pick stocks, index funds automatically follow the index they are designed to mimic, offering broad market exposure and lower costs due to passive management. So, how do index funds work? The value of individual stocks within an index fund is averaged together into one single price. This means that when you invest in an index fund, you're essentially buying a tiny piece of each stock in that index. This averaging effect helps to spread out risk, as the performance of the fund isn't tied to any one company, but rather to the overall performance of the entire index. This is why index funds are often seen as a safer, more stable investment option. Index funds are created and managed by investment management companies like Vanguard, Fidelity, and others. These companies select a group of stocks that match the criteria of a specific index and package them together into a single fund that investors can buy into. By investing in these funds, you're essentially placing your money in a diversified portfolio of stocks that mirror the performance of a specific market index. One of the most notable market indices is the S&P 500. This index comprises 500 of the largest and most influential U.S. stocks, including major companies like Apple, Microsoft, and Amazon. The S&P 500 is considered a good representation of the entire U.S. market because it includes a broad cross-section of industries and reflects the performance of a significant portion of the American economy. It's essentially a snapshot of how the largest and most influential companies in the U.S. are performing. Warren Buffett, known for his legendary investing success, has often recommended investing in S&P 500 index funds. He believes that these funds provide a simple, effective way to gain exposure to a diversified portfolio of top U.S. companies while minimizing the risk associated with individual stocks. In fact, Buffett's advice to invest in low-cost S&P 500 index funds has been a cornerstone of his investment philosophy, emphasizing both the value and the wisdom of this approach. So, why does Warren Buffett like index funds so much? Let's break it down. First up, lower risk. Index funds are essentially a collection of stocks, which means you're not putting all your eggs in one basket. By investing in a broad range of companies, you spread out your risk. If one stock performs poorly, it's offset by the performance of others. This diversification helps to stabilize returns and reduces the risk associated with individual stocks. Next, lower fees. Unlike actively managed funds where fund managers make frequent trades and charge higher fees for their services, index funds usually have much lower fees. This is because they simply track an index rather than trying to beat it. Fewer trades and less management mean more of your money stays invested, potentially leading to better long-term returns. And then there's transparency. With index funds, you always know where your money is going. They're designed to mimic the performance of an index, so you can see exactly what stocks are included and how they're performing. This level of transparency helps investors stay informed and confident about their investments. In summary, Warren Buffett's preference for index funds boils down to these key benefits: reduced risk through diversification, lower fees that help maximize returns, and transparency that keeps investors in the loop. It's a strategy that embodies Buffett's belief in keeping things simple and effective. Now, let's talk about the specific index funds Warren Buffett has in his portfolio. Buffett's investment strategy includes 2 notable index funds, the SPDR S&P 500 ETF Trust, SPY, and the Vanguard 500 Index Fund ETF, VOO. SPDR S&P 500 ETF Trust, SPY, is one of the most widely recognized ETFs that tracks the S&P 500 index. It aims to mirror the performance of the 500 top U.S. stocks, giving investors broad exposure to the U.S. equity market. Then we have the Vanguard 500 Index Fund ETF, VOO, another popular choice that also tracks the S&P 500. Vanguard is known for its low-cost investing approach, and VOO continues that tradition by offering a cost-effective way to invest in the S&P 500. Both of these ETFs are excellent examples of Buffett's preference for low-cost, diversified investment options. By investing in these funds, you're essentially investing in a wide array of top-performing companies, which aligns perfectly with Buffett's philosophy of simplicity and effectiveness in investing. So, if you're looking to follow Buffett's lead, these index funds are a great place to start. They offer diversification, lower fees, and a transparent investment strategy, all key factors that make index funds an attractive option for many investors. To wrap up, Warren Buffett, one of the most legendary investors of our time, has shifted his stance towards favoring index funds over traditional stock picking. This change underscores a powerful investment strategy, diversifying across a broad range of stocks while minimizing fees and complexity. Buffett's endorsement of index funds like SPDR S&P 500 ETF Trust, SPY, and Vanguard 500 Index Fund ETF, VOO, highlights their benefits: lower risk, lower fees, and full transparency. These funds offer a simple yet effective way to tap into the growth of the overall market. So, if you're re-evaluating your investment strategy, consider incorporating index funds into your portfolio. They might just be the game changer you need to achieve your financial goals with less hassle and greater peace of mind. Share your thoughts on the Warren Buffett versus index funds debate in the comments below. And if you found this video insightful, don't forget to hit that subscribe button for more investing updates.